Hey everyone, welcome back to the Daily Gold Podcast. Today I'm speaking with Tiho Brkan. He's the author of the Short Side of Long blog, which is really growing in popularity, and he's also a fund manager. Uh, Tiho, it's great to have you back. How are you?
Excellent. Yourself?
Oh, I'm very well. I should let our audience know we just had a spirited discussion on various markets, and you and I were also debating some points. But let's get started off with your take on, let's talk about general markets, and I guess the S&P 500. I mean, as everyone knows, um, the investors and traders are becoming so addicted to QE, and they're basically just waiting for the words that come out of the mouths of Draghi and Bernanke and all that nonsense. And we see the S&P pushing higher, about to retest its high. What's your view on this? I know that you still believe that the next big move is going to be down. Maybe you can just summarize some of the reasons why you believe that.
Sure. Well, basically, my view on the S&P 500 is that the next great move, like you said yourself, is going to be on the downside. Um, the bull market, the cyclical bull market, is happening within the context of a secular bear market, which started in March 2000 and was sort of 12, I guess you can make a comment, 12 or 13 years in, depending on which peak you pick. And the upside, in my opinion, specifically with the S&P 500, is kind of limited. I think we're going to be in this secular trading range. So the upside is 1500, the downside's about 800, 700, depending on which supports you pick. Um, so from here, we currently could rally maybe 5% on the upside, but I think the possibility of a decline and a recession, a global recession, and an earnings disappointment is much higher. So therefore, I think that the next great move in the S&P is most likely going to be down. I don't really do any targets. Can't really tell you where it's going to go and how long it's going to take to get there. But basically, if one was to just take a round number and say, currently we're about 1400 and the earnings picture is about $93 per share for the S&P 500. And majority of analysts expect earnings to go above $100 this year and next year into 110 type of an outlook. With revenues now disappointing, with the worst quarter performance since I think second quarter of 2008, what we could get here is a disappointment on the downside where earnings maybe don't go up by 10, 20%, they actually fall down by 10, 20%. And if they do that, even earnings picture around $75 per share, which would be quite a disappointment. And if you were to put a 12 times multiple of that, you can do the mathematics yourself. I mean, it's pretty evident that we could go down below 1,000. So I'm not predicting that, but it's quite a possibility.
Now, just to follow up on that, Tiho, obviously, the stock market is a market full of many different industries and stocks and so on and so forth. In the last bear market, cyclical bear market, I should say, it was obviously the financial, the housing sectors, which really were the leading performers on the downside. Um, what going forward, what sectors do you see as the most vulnerable here?
Yes, well, first of all, when a bull market is rising, you want to see broad strength. And when a bull market is aging, usually you see narrow breadth. So I think that's what we're seeing here number one. So currently, the last bit of this bull market that's occurred has been really pushed by defensives. I mean, I've looked at healthcare stocks, staple stocks, and utilities. And I know utilities don't really make up a large weighting of the S&P, but staples and healthcare have really pushed this market much higher. And obviously technology has done well and things like that too, but there's been quite a few laggards there. So, I think technology is overvalued. It's not like it was in the bubble in 2000, but it's gone up about, I think, NASDAQ 100 is up about 130% or 140% from the March '09 lows. So that's quite overvalued for 3 years of a run up. A lot of people can argue that stocks can run a lot longer and a lot higher and for a lot longer. Sure, I mean, anything is possible, but statistically, I have done research going back to 1900s. and basically looked at data for things like S&P 500 and Nasdaq 100. And what I've noticed is that majority of cyclical bull markets last for a certain amount of time and they gain a certain amount of percentage. We've now lasted much longer than an average cyclical bull market, especially a cyclical bull market in a bear market, in a secular theme of things. And we've also more than doubled. I mean, don't forget that the bull market from 2002 to 2007 has gone up only 100%. We're down 110% for the S&P and 140, as I just said, for Nasdaq. So I think technology can lead on the downside, and I'm quite negative on things like discretionary and staples. I think they can really disappoint. So I'm looking at consumer stocks right here to most likely lead on the downside. But overall, it remains to be seen. I think if China has a hard landing, which I think it most likely will, I would not be surprised to see mining companies, commodity-related companies really take a beating as well. So it remains to be seen. But we can make a lot of arguments for and against every single sector. I rather not, and just let the market do its thing.
Yeah, let's move on and talk about bonds because you were one of the first people to bring up this conundrum of the strength in bonds, heading into recession. And I mean, this is something that you and I, we talked about. We have talked about it several times. What are your thoughts on the bond market? Because obviously it's had such a strong run. And as you say, the fundamentals of the global economy are getting worse. I mean, it's very possible that we haven't seen we haven't seen the worst, or we haven't even seen that much bad news out of companies. What does that mean for the bond market? Can you give us any analysis there?
Well, basically, the bond market had a proper bottom in September 1981 at about 44 on the long bond, and currently we're 146. So in percentage terms, that's 15% interest rates in 1981, and today we're, I guess, less than on the long bond, less than 3%, 2.9%, 2.93, depending on how specific we want to get. So in the grand context of things, these great interest rate cycles last about 30 years or so, called contractive waves, and we've been in a declining wave for interest rates since 1981. So eventually, somewhere around here, the great bottom for interest rates will occur, which means a great top for bond prices, and they will be a short of a lifetime, spanning back for next decade or two or even longer, depending on how long these cycles run. Having said that, and we're currently in the bond bubble, and they're very overvalued. If I was to take my capital and lend it to the US government or any other developed market government with high levels of debt on their balance sheet and a definite possibility of devaluing their currencies, if I was to lend my capital to governments like the US over a 10-year span, I would have to be paid at 1.8% per year. And I mean, inflation, let's be honest, is not running at 1 or 2 or 3%. It's running at much higher. So therefore, I'm definitely losing money, whichever way you look at it. A lot of people currently in this bubble make an argument that the bond prices are more so about buying into the bonds because you're going to get the return of your capital instead of the return on your capital. So it's more like the safety crowds reason for why the bond bull market's continuing. I wouldn't actually go and buy bonds. I think they're very overvalued, as I've stated. But having said that, there's a huge fundamental negative backdrop occurring, and I just don't know how everything will play out when the stock market goes down. Because my opinion is that we're going to have a global recession post-elections. It's going to become obvious that the stock market's in trouble, that the global economy is in trouble, that nothing's been solved, and nothing's going to be solved when Merkel wins, and nothing's going to be solved when they bail out Spain. And eventually we cannot continue like that, and can kicking will eventually stop, and the market will take control. And when that happens, it's going to be very nasty. At that point in time, I'm not sure how bonds are going to react, but don't forget that in 1999, everybody called Nasdaq a bubble, and then it still doubled into 2000. So who knows? I mean, I don't know. So, we should ask a weather forecaster.
Or maybe we should watch CNBC or Bloomberg since they The frequent guests they have always seem to get it right,
Yeah,
exactly right, 100% of the time.
exactly. They know everything. One thing that I want to say is that I don't want to be a seller of bonds right here unless it's a long-term outlook. And also, I don't want to be a buyer. So that's why I don't know. I'm very unsure because if a global recession does happen, I just wonder where all the money is going to rush into. And most likely, it could be bonds. Having said that, with such high valuation in bonds, one could also make a case that they could be topping right here because technically they look very weak, even over the long term. And there's no rule that states that stocks and bonds can't decline together. Not that I'm trying to predict that, but so therefore, as you can see, I'm not 100% sure. One thing that I want to tell you is that one observation I have that's very interesting is that United States asset classes are extremely overbought. The S&P 500 is making 52-week new closing highs. The bond market's very close to 52-week new highs, and it's just recently sold off in the last couple of weeks. And the US dollar has done the same. So your currency, your government bonds, your corporate bonds, your junk bonds, your stock market, your technology sector, everything in the United States is overbought. The bonds, the currencies, and the stock market. There's been a great flight of capital into your country because of the Eurozone mess. But, as a contrarian investor, not a trader, but an investor, I don't see any value in the S&P stock market or the Dow Jones or whichever other one we can pick, like the Russell or whatever. And I don't see any value in the corporate bond market or the government bond market or the junk bond market. I'm extremely negative on all of them. And I'm also extremely negative on your currency. But I do admit that government bonds and the US dollar could go higher if things really get out of hand in the rest of the world, especially in Europe and China. Having said that, I'm not a buyer of none of those because they're way overvalued.
All right, well, let's close. Why don't you tell us, what you're doing as far as your management? I know that you've been long silver, you've been short some areas. Are you thinking about, increasing or putting some more capital to work in precious metals?
Yes, I mean, I'm always looking to increase capital into precious metals because, after all, let's not forget that this is a secular bull market. In secular bull markets, there's only one thing to do, regardless of if the price declines for a period of 6 months or 12 months or 18 months. In a secular bull market, you should only be bullish. It's as simple as that. You can be sort of neutral, or you can expect a correction. You can be cautious, but the surprises in a secular bull market always occur on the upside, um, or I should say majority of the time occur on the upside. So therefore, I think that eventually the precious metals secular bull market will regain on the cyclical side as well, and the rally will start. I don't know if that's going to be tomorrow or in 1 week or in 1 month or in 12 months, but I do know that eventually it will go higher. Um, your readers know really well, as the rest of the whole world does too, that the gold and silver and precious metals in general, the whole sector sort of in this really tight range. Maybe the stocks, the gold mining and the silver mining stocks, some of them like Silver Wheaton and gold mining juniors and some seniors, they seem to be breaking on the upside, some of them, and leading the pack. But specifically gold and silver, which I'm interested in, they seem to be dead quiet in this current range, which started in the late May and it's now going on into late August. So I think silver has traded in the range between 26 to 29 for about 15 weeks. And sentiment's quite close to negative. It's been negative for a long and steady period of time. One thing that I recently noticed as the new data that I got is that over the last 3 years, or even quite longer than that, to be honest with you, over the last 5 years, the short interest ratio on GLD and SLV is actually at the highest level it's been for at least 5 years now. So the last time I purchased silver in a large proportion was in December 2011 when the price reached about $26, and the short interest ratio was the highest it was back then for 4 years. Now it's even higher, and the price is still around $26, $28. So there's quite a lot of pessimism on precious metals, and maybe they will break down, maybe they will break up. Eventually, we want to add some more money to the precious metals bull market, but I do want to see some momentum start up. We're in a very good seasonality period where from August, say, to January, precious metals tend to rally and do much better than they do, say, from January to July. So that's another positive as well. But I do want to see some price momentum. The other thing that I'm doing with my money is I'm short in the stock market. Currently, I have some shorts at the Dow Jones Transportational Average because it does not confirm the Dow Jones Industrial Average, and it looks quite negative to me with the Dow theory. And I also think that the technology sector and the discretionary sector are way overvalued. I think specifically Apple is now worth $600 billion as a market cap as of last night, and that's valued more than the material sector altogether. So if you think about the S&P material sector and all the great mining companies that are found in there that actually produce real things, that are sold to real countries that consume things and create things, well, Apple pretty much is valued more than all of those mining companies put together. And same goes with other sectors as well. I think it's valued more than telecom, and it's valued more than utilities and a few other things. So, I mean, I think technology in general is it's not a bubble like it was in 2000, but I think there's some type of euphoric feel there, and I don't think that the story is going to look very good come 2013, where the prices could be lower. And, so I remain long precious metals, a little bit of agricultural position as well, as I've stated before to your readers many times. And at the same time, I'm looking at shorting stocks. So I think over the long-term view, say into 2014, because I like to invest. I don't like to trade over the next 5 minutes or 5 days or 5 weeks. Over the long-term view, into 2015, I think precious metals will be much higher than they are today. And into 2015, or maybe even much earlier, like 2013 or 14, I think the stock market will be much lower than it is today. So I don't know if I'm going to be right. Hopefully I get my shorts right as well as my longs. We'll see how this conclusion for the secular bull market in precious metals and the secular bear market in stocks plays out.
All right, Tiho. Well, we'll have to leave it there. I know you have to run, but thanks so much for your time and your great insight as always. I and my listeners really appreciate it.
Absolute pleasure, and let's do it again sometime.